Hi, and welcome to chapter 32. This is our last group of chapters, and I'm really excited that we're finally here. So let me go ahead and share my screen with you, and we'll start with objective one. There we are. Okay, so here what we're going to do is to discuss a little bit about the loanable funds market in an open economy. So here is our learning objectives. And so again, just some things to remember that when we talk about those things that determine trade, and what we're going to do is to look at the loanable funds market and how foreign currency, foreign markets impact our own domestic market. And we'll look at some other examples of that as well. So just to remember a few things, in an open economy, national savings is equal to investment plus net capital outflow. Okay. The supply of loanable funds, we know, comes from savings. Remember that. Just to remember, it is private plus public. And if we want to break it down into the exact terms, it's GDP less taxes, less consumption, plus government spending. I'm sorry, taxes minus government spending. Let's see. Boop. Get my eraser here. Okay. Taxes minus government spending. Okay. Now, one of the biggest changes when we open up this economy is the demand for loanable funds was previously in a closed economy just I, right? Just this investment term. Now we're going to add in net capital outflow. Okay. So let's go ahead. If net capital outflow is positive, again, that would mean that what? Net exports are positive. We would have a trade surplus. And this adds to the demand domestically for generated loanable funds. Okay, so it adds to the demand curve. If we have a trade deficit, as we do here in the United States, so negative, and it would be a trade deficit. There is capital is coming from abroad, okay, and it reduces the demand for domestically generated assets, so or loanable funds. So let's talk about a little bit about that. So reduce the demand. Okay, so remember the demand is investment that is happening in a country. So in this case, if we have a trade surplus, then we're going to have more demand for loanable funds because the dollars are staying home. If we have a trade deficit, then we're going to have less because that means that dollars are going to flow to foreign markets. And we will have a reduced demand for U.S. loanable funds. So again, loanable funds, so domestically U.S. generated flow of resources available for capital accumulation. That's what makes it an investment. Okay, so the purchase of a capital asset like machinery to a farm adds to the demand of loanable funds. The asset, if it's at home in the US, we call it investment. If that is located abroad, it becomes net capital outflow. So where is that capital asset? That kind of depends on if it is going to be an investment or net capital outflow. Now remember, we talked previously about this, and we had that if this is the demand for loanable funds, just to refresh your memory, and this is our interest rate, that the demand for loanable funds comes, well, here's the demand for loanable funds, the downward sloping, but let's start with the supply of loanable funds. That comes from two places. It comes from the private plus public And we called that previously national savings. Okay. The demand for loanable funds comes from people wanting to invest in businesses here in the US, or it could be individuals that are investing abroad, or more so foreigners that are investing in the United States. Where these two crisscross right here is going to be the interest rate, and this will be the quantity of loanable funds. Now let's take a look at what happens. Okay, the higher the real interest rate, that would be this part over here, this real interest rate, encourages people to save, right? Because higher interest rate, okay, increases the quantity of loanable funds available, okay? So we can just take that first statement and illustrate it here on the graph. So if this were 5%, and then it goes up to 8%, people don't want to borrow as much, so we would call that one Q1. But people want to save more, so we would call that Q2. So people not wanting to borrow as much is the second portion of this. It discourages an investment. It decreases the quantity of loanable funds demanded, right? Because we're right here. That's what the second little bullet means. Discourages Americans from buying foreign assets. So it reduces net capital outflow. So again, why? Because money's going to go to wherever the interest rate is highest. If the interest rate is high in the US, then Americans are going to keep their money here at home in the US. Okay? Now, it encourages foreigners to buy US assets. Why? Because interest, again, people are going to want to buy where the interest rate is high enough, so bonds and so on. So we're going to have foreign money. I'll just go ahead and put a yen symbol coming into the US, okay? And that means it reduces US net capital outflow. So part of why we're back here, I'll call that point A, part of the reason we're back here is because net capital outflow is foreigners are buying US assets. So that's part of the reason. Okay, so remember the supply of loanable funds or national savings slopes upward. Why? Because the higher the interest rate, the more people want to save. The demand for loanable funds, which is here, which is equal to investment plus net capital outflow, is the downward sloping curve where these two crisscross. That will be the interest rate, and this will be the quantity of loanable funds. Okay. All right, so this is just a much better, nicer looking graph to kind of show you that the equilibrium real interest rate is where national savings equals investment domestically plus net capital outflow. Okay, that's the end of this learning objective. Hi, and welcome to chapter 32, learning objective 2, where we're going to take a look at the market for foreign currency exchange. So let's go ahead and jump into this. And the first thing I wanted to do is just to clarify some things to make sure you're on the right track. All right, so let me go ahead and start the slideshow. I thought I did that, but I guess I didn't. There we go. Okay, so we're going to describe this market for foreign currency exchange. And I want to bring back an idea that I started when we opened up this economy, and that's the idea of the relationship between net exports and net capital outflow. So let's imagine we have the US over here, we have Japan over here. And remember, when we opened this, I said it's not a true idea, but I want you to imagine if the US is selling goods to Japan, we're exporting. And we know that that is part of the net export side, right? So we're exporting goods to Japan, that those goods are priced in US dollars. Okay? So what Japan is going to have to do over here in its home country is it's going to have to exchange yen to dollars. Okay? It's going to have to go through that process and then send the payment back to the company that it purchased from here in the US. This portion, the lower portion here, let me just put it in a different color to keep it clear. This lower portion here and here becomes the net capital outflow, even though it's coming into the country in this case, right? So this becomes the net capital outflow. And that's why we said they must balance each other, okay? So the market for foreign currency exchange focuses on what's happening here, okay? Now, if we have an import, which is predominantly what the US does, then Japan is selling goods to the US, those goods priced in yen. Okay, so here's Japan. Now the US has to be able to take US dollars and convert them into yen to be able to pay that bill, which is part of the net capital outflow. So when we talk about this, one of the things we'll see is that the amount of net exports over here really kind of drives the amount of demand that we have for foreign currency. Okay, and where do we get these yen from? That's the great question. Now, where we get these yen from is that Japanese citizens will want to do financial investing. Remember, we talked about two ways. There's portfolio investment and direct investment. So the Japanese will want to purchase or may want to purchase US financial assets. When they do that, they purchase them in yen, which then gives the US the yen that they need over here to buy their products or their services. Okay? I thought that was kind of important to kind of stop for a second and go, hey, wait a minute, let's make sure we understand that. Okay, so going back, we know that net capital outflow is equal to net exports. This is the physical, the goods and service side of it, and this is the monetary side of it. Okay, so if we have a trade surplus, remember a trade surplus is that we are selling more to other countries than what we're buying. The first example I showed you there. So the sale of goods and services abroad. So Americans use foreign currency to buy those assets, okay? And I'm going to say foreign stuff because I think assets is a confusing word in some of these slides. So basically what is happening is capital is flowing abroad. And when we talk about capital here, we're saying that US dollars are being exchanged into foreign currency, and that foreign currency is what's flowing abroad. If we have a trade deficit, again, this is predominantly what we have in the US. So we import more than we export. Some of the spending is financed by Americans selling financial assets abroad, right? So again, this kind of just culminates what I talked about a few moments ago, that the financial sector, right? Financial investing is necessary for net exports. right? So that's where the sources of this stuff comes from. We'll look at it in a graph in just a moment. So here, foreign capital is flowing into the U.S. because we're selling American financial assets, just like we talked about. Perhaps the Treasury, the U.S. Treasury has a bond, and they're selling that to a Japanese citizen. That Japanese citizen takes the bond and injects what? Foreign currency into the U.S. market. So that's why we're saying foreign capital is flowing into the U.S. So net capital outflow is negative. Okay, here's a graph. And what I want to do here in this graph is just to show you the supply side first, and then we'll look at the other side. So there's only so much foreign currency and so many dollars supplied to buy foreign assets, right? Based upon what is the demand and supply. So here we're going to take a look at the supply of the foreign currency exchange. This is the supply. It is perfectly inelastic. Okay. Now, why is it perfectly inelastic? Because it doesn't depend on the real exchange rate. Okay. So this is the quantity of US dollars that we have for net capital outflow. Okay. Now again, perfectly vertical. Okay. This downward sloping portion right here is the demand. And the demand is the quantity of dollars demanded to buy net exports, right? So the demand for foreign currency exchange comes from the fact that we demand foreign goods. It's downward sloping. Now, what happens when the real exchange rate changes? It makes US goods more expensive in foreign markets. Because US goods are more expensive, this is going to do what? It's going to shift in the demand for US dollars to pay that bill. Okay, to D1. Lower real exchange rate's going to push this outward. Over here. Okay. The equilibrium real exchange rate, again, what is the demand for dollars by foreigners? Okay. And then again, it rises from net exports. So if we are exporting more because our goods are cheaper, then foreigners are going to demand more US dollars. Okay. Now, the demand for dollars exactly balances the supply because, again, the supply of dollars arising from US net capital outflow. So notice again, we have this very intricate idea that the demand for dollars by foreign countries versus the supply of dollars from Americans in terms of net capital outflow. Okay, this is a really good graph and I like it a lot. So remember, this is the supply of dollars. So we'll call that supply of dollars net capital outflow. We then have the demand for dollars for net exports. Again, I'll just put NX here because that's the good side of it. Where those two crisscross, we have the equilibrium real exchange rate. Now remember the real exchange rate, good for good, right? Real exchange rate. So this is what balances out the real exchange rate is the net capital outflow, the supply of dollars by foreigners that want them. Sorry, I misspoke. The supply of dollars, there we go, wanted to buy for exports. So this is supply for imported goods. Okay. And then the demand for dollars is the quantity of dollars exchanged into foreign currency. Okay. All right. So that's the end of this learning objective.